Hello, good afternoon, panelists and the participants. Welcome to this webinar that has been organized by the Institute of Certified Public Accountants of Uganda. And today's topic is implications of COVID-19 on IFRS 9, and that standard is on financial instruments. So I can see we are almost approaching 300 participants, and we need to start immediately such that we get enough time for discussion. So your chair for the session today is CPA Dr. Albert Otete. I'm a practicing accountant and also a member of the ISPAU Education and Research Committee. You are all welcome, and let's have a fruitful discussion. So today's panelists, we have two very experienced CPAs. The first one is CPA Samuel Frederick Mogeza. He's a certified accountant and certified professional coach with over 17 years working experience in financial institutions sector, and currently is working with Stanbic Bank Uganda Limited as the Chief Finance Officer. So you can see his biography has been put on the screen for you to note. Just for further emphasis, he was recognized as the top CFO in Uganda at the Deloitte SCA Awards in 2018, and also the CPA of the year 2019 by ISPAU. Because he has experience in banking, you have seen the banks there: Citibank, Barclays, Stanbic, Standard Bank. So definitely those are the institutions which are most affected by IFRS 9. So Samuel is a board member, trustee, committee member of various institutions, and we welcome him to this webinar. So if we go to the second panelist, briefly, can we put the brief? Yeah, the second panelist is CPA Frida Kaheru Agaba, who is an associate director in Ernst & Young, Kampala, and has experience in audit and consultancy services spanning over 14 years. So therefore, our experience in Uganda and other E&Y offices will be very useful for us to listen to that kind of experience. She's a CPA and also holds a bachelor's degree in accounting and finance from University of Kent. So ladies and gentlemen, fellow CPAs, those are our panelists for today. And we want to kick off immediately by inviting CPA Samuel Frederick Mogeza to take us through. But before he starts, just to note that we have the Q&A tab where you can post questions by typing there. And then also at some point, we shall be able to give participants a chance, if there's time, to ask questions online. So welcome CPA Samuel Frederick Mogeza to take us through the presentations for today.
Thank you, CPA Alfred, Dr. Alfred Otete, and thank you for the warm introduction. And quite excited to see the number of participants that is growing on this very topical issue, which myself and CPA Frida will take us through this afternoon. There are no golden insights, but there are insights that hopefully we can share. And we've agreed with CPA Frida that she will do most of the difficult work around the more detailed implications. And what I will be doing is walking us through the context setting and some implications, but the detail, just so we don't overlap too much, will be done by CPA Frida. I'm going to share my screen, presentation that I have, and I have shared the screen now. I believe the chair will confirm that my screen is well shared. If CPA Alfred, if you can give me a thumbs up.
It's shared.
Thank you very much.
Yeah, it is there.
Thank you. So this is the content I'll share today. I'll look at the operating environment and the COVID impact, and then some insight on the state of the financial sector and the regulatory response that we've seen to this point, and some of the questions that are emerging from that regulatory response. Then on the broad implications, as I mentioned, I will give a very brief, high-level comment on two of the key ones emerging, and CPA Frida will take us through a more detailed elaboration of that. So in terms of the operating environment, this is familiar to all of us, and it's important to, we know it's a global impact. There's 147 countries with lockdown measures out of 195. This is a truly global pandemic, and there is no country at this point that is completely unimpacted by the COVID-19. We've seen travel restrictions, international travel, and of course the repercussions of that, not just on the airline industry, but also on trade and the tourism sector that feeds off that industry. And I'll speak to some of the sectors that we've seen impacted most. We've seen the education area impacted significantly, about 1.4 billion globally impacted. And there's evolution of what some countries are doing from that perspective. But some countries are less able to seamlessly move into digital provision of these services. Job losses across multiple sectors, entertainment, automotive. In fact, what one could say is if you look across multiple industries, you start to see the impact of this pandemic spread across what were initially core sectors impacted to other sectors that we are feeding off, because it's an ecosystem that is connected. Oil prices, I'm sure we're all aware, have actually turned negative. There's excess supply of oil, not enough storage, not enough consumption. That has impacted oil price, electricity. And then we can see some other things that are exploding around Google and other data-driven pieces of information. So that's a global view. And if you look at the center, it shows world GDP, which was quite strong before this at about 3.3% as of 20th of Jan. As of 2nd of March, a few months later, 1.5%. And now we are looking at depression. So it's a significant impact in a short space of time. A quick insight on the global stage, you see that there are some beneficiaries to the pandemic, and that's a key message, that there are always going to be some winners, even in situations such as this. What we're seeing globally is that for the entities or the companies that are operating in areas to do with connectivity, Zoom, the platform we're using, and other similar type entities, they are benefiting from higher valuations. Entities that support or are driven off home comfort, a lot of Netflix users are picking up usage of those platforms. Those continue to go up. And then on the e-commerce side, Amazon and anyone who has a significant digital proposition has begun to see benefit come through at this point. And that's a very key point, because entities that are being able to evolve digitally and create their value proposition through digital interfaces have been able to weather the storm quite well. Then just in terms of global impacts, the widest impacted areas are as indicated. So of course, what this shows is the sectors and the estimated global restart times. How long will it take for these different sectors to restart? Now, you can see the highest impacted one is commercial aerospace. You think about commercial airline industry as well. And you can see that that is one that has taken the most significant impact and expected to have the longest recovery period. Air and travel follows next. And again, we continue to see a lot of tourism-linked sectors plugged into here, which have struggled, coming off the fact that people are not moving across borders as they used to before, and that's impacting that sector quite strongly. The insurance carriers, oil and gas as well. We talked about the oil price. The automotive industry, there's a lot fewer cars on the road. There's a lot of disruption in terms of supply chain and production disruption, particularly in some of the markets that were very keen on manufacturing in this space, and the apparel and fashion. So anything that is now almost a non-core, non-necessity being impacted quite significantly. And you come closer to Uganda, come closer to home and say, what does that look like? Again, the industries, the sectors are very familiar, very similar to what we've talked about from a global perspective. Tourism and travel, the travel restrictions have fundamentally impacted that sector. And this becomes very important when we talk about the sectors, because it impacts how we think about the financial instruments that are exposed to the sectors, either at a counterparty level or where the counterparty is connected materially to these sectors. It becomes very important to understand the shifts happening in these sectors. On the retail space, significant depression, non-food items have gone down significantly. There's a lot of focus on food items, manufacturing and industrial. The disruption of the supply chains has been a key issue. Stanbic runs what we call production index that gives a sort of forward-looking view or a more current view of what the economics look like within the market. And it clearly shows that supply chain disruption has been a material factor impacting production, impacting flow of capital. So these are material impacted areas, especially around manufacturing and industry. Agriculture, of course, heavily impacted. The floriculture space quite significantly impacted. All export-driven flows have been severely impacted. And you continue the list into real estate, where there are concerns around that sector. And the slowdown that we're seeing already happened quite significantly in Uganda already, and how that might inform how we look at our collateral, and to sort of preempt what we'll be talking about from an IFRS 9. But as you look at the sectors, you begin to get a sense of this sector impact. What is it going to mean in terms of the organizations that are dependent, reliant on these sectors, banks that fund and lend into these sectors, and the collateral that supports loans into these sectors. Oil and gas we've spoken about, construction as well, spoken about, and then the telecom industry as well, where we're seeing them benefiting. In fact, if I consider some of the stories we're hearing on telecoms in other markets, think about Safaricom, where their Safaricom product of M-Pesa is very well integrated in the market and is very much part of the ecosystem of the retail financial sector there. And we're seeing a lot of liquidity move into that retail financial space. Not to a significant extent locally here, but we do still see telecoms benefiting from that shift. And we can anticipate that whoever has a mobile money or a wallet proposition is going to benefit in this time. Just quickly on Uganda, I think we all know these numbers. We all see these numbers. We track the address on the cases. We have seen a pickup on the cases. It is a concern. We are now edging towards 500 cases. Based off original count numbers, the rebased number is somewhat lower, but you can see that that continues to be a trend that we will see. In terms of the highlights, IMF support has come in quite strongly. We see that there is material funding that we expect to prop up certain sectors. And it's a key point because it also speaks about what fiscal interventions we can expect to see. And watching the budget reading quite closely is going to be very important in terms of the priorities and how the government is going to look to set a fiscal stimulus to address some of these challenges. And this is all critical into IFRS 9, as we'll see later. Economic policy, we're in uncharted territory, the central bank rate at an all-time low, So interest rates for the banks is going down quite significantly, and we can expect that to continue. Businesses and investors are disrupted. Workforces, we talked about, salary adjustments, so job losses, the workforces are impacted. There's significant indicators of strain that we see specifically in some sectors, but also generally you can see some signals that tell you that there is a real pressure in that space. Monetary policy, as I've spoken about, and I just included this here to give a context of some key parameters, which are key macro indicators. You look at the headline inflation, you look at the central bank rate, you look at the 364 treasury bill rate, and then the local currency lending rate in the market, giving a sense of what is happening on these metrics, these macro metrics over a period of time. If you look at full year 2016, which is the section here, which is to my far, which should be to your far left, you can see headline inflation was low. The central bank rate was just shy of 15%. The 364-day rate was about 17.6%. These are high numbers. And then the local currency average lending rate, about 24%. So a high interest rate environment, inflation higher than the benchmark or the target set by Bank of Uganda. Not materially so, but higher. If you fast forward and come all the way down to where we are at this point in time, you see that very clearly the central bank rate dropping to 8% in April. It was 9% as of Q1 2020. It's now 8%. That's coming from 15% to that level. You can also see that the average lending rate has dropped from about 24% to 19.5%. This shows you that rates in the environment are going down quite quickly, and headline inflation has also moved. But the key measure there is the central bank rate is the lowest that it's been since inception. So monetary policy is very accommodative. Private sector credit growth gives us a trend from 2017. What does it look like? We've seen the pickup of private sector credit growth, picked at the levels we saw in 2019, having come from the low points of 2017, but has started to come off. And this is only up to February 2020. When we look at these numbers into March and April, and many of the bankers will also attest to this, there's a noticeable reduction in loans that are being disbursed, loans that are being approved, simply because of risk appetite changing as it has, and also the implications of that on the loan growth for these entities. Economic forecasts also indicated here, we've come from some good highs, 6.5%, 6.2%, but now the forecast that we're seeing is at 3%. So the macro environment has significantly shifted. And again, CPF Reader will throw more light on this, but what this means is that the integration of this forward-looking view has a material impact on how we think about these instruments, these financial instruments, as we'll see subsequently. Now, if you look at sectors, and again, it's important to look at sectors to just get a sense of what are the sector sizes, how have they been growing, and the sector view and the elevated view on understanding the implications of COVID on sectors becomes critical also as we consider how that might impact loan exposures to those sectors. I put this slide here, and I won't speak to it in detail, but there is all sorts of interesting letters being picked to indicate what the recovery might look like, the economic recovery. Because we see that we're in a dip, but what might that recovery look like, and how quickly might it shape up? Because that informs how we build up our assumptions and how we think about scenarios that we then derive from this information into a forward-looking view of our businesses. So there's a V-shape that just simply says there will be a quick rebound after the lockdown restrictions are lifted. GDP will bounce back quite quickly. And this is what we typically call a very bullish scenario, which hopes to see very quick recovery in a short space of time. The U then is a little bit more pessimistic, if you like, and says recession will extend into Q3, given the lockdown implications that we've had. But we will see a rebound into 2021 that will be quite strong. And then the economic activity will quickly pick up following that low point, given the challenge of how long the recession has taken. The W then also says the global economy will experience major shocks, and we will then see a recovery, a drop, a recovery as infections are seen and as they pick up, and the supply chain disruptions remain, which basically means a lot of volatility in the short term and into the medium term. And then the worst of these letters is the L, which is the bear, what we call the bear case. And bear simply means it's the worst case. It's the worst possible outview that says the pandemic will last for a while. We'll see a steep drop in economic activity. Demand will be severely disrupted, and there will be a long-term impact of that disruption. So even as we think about how we are modeling our future economic views, we need to think about what sort of letters are we thinking will be the forward-looking view of the economy. And that then will inform what we call our bear view, which is the worst case, our bullish view, which is our best case, and then you know, the best view, which is maybe the more anticipated case. So very quickly on the sector and the regulatory response. This is just a snapshot view of the financial sector. And I've put this here specifically to give context from a bank perspective. This gives you results for 2019, where you see about 43.4% of loans and advances, or rather, the total assets in the industry, 43.4% are to loans and advances. If you then look at the interest earning assets, about 55% of the interest earning assets are loans to customers. Now, when you build that further, you'll find that over 85% of what we see as interest income actually comes from this book. So it elevates the criticality or the impact of this book on the performance of the organizations. I've also included this slide here that gives a very summarized view around the performance of the sector in 2019. You can see that from a PAT perspective purely, we grew from about 751 billion as a sector to 850 billion. You look down a bit further, you see that one of the big drivers of this performance is interest income, of which 85% comes from loans and advances, which tells you that there is a critical risk around the highest factor that grows the interest income in this industry. You can then also see that this interest income grew 16%, but interest expense grew 22%. Non-interest income grew about 13%. And then impairment, in a year that was not very, very difficult, grew by over 70%. And there are some nuances to that. You know, the first time adoption of IFRS 9, a lot of conservative approaches were taken across the industry. And that day one adjustment was done against equity, which when these were being reversed back into the P&L. So 2018 had that dip to that extent. But the 71% is still a material increase year on year. But the question is, what will it look like in a COVID situation, in a post-COVID era? And that begins to become a critical area to have insight on. The costs growing at 10%, and costs tend to be sticky when they grow, so some real action has to be taken upon that. But the real point of this slide is to show you that interesting view of interest income, which is the primary driver of performance of the industry. Now, my last slide on the context of the industry just shows you and says, what is the shape of this industry? And it also elevates what makes this conversation we're having very important. We have about 50% of the banks with a cost to income ratio above 75%. That's a big number. And it means that, you know, for these entities, a large amount of the income they generate is taken up in the costs, and there's not enough material flexibility on how much they can take on impairment and provisions and that sort of thing without becoming loss-making. We already have 7 loss-making banks in the industry. So it raises the question, how high of a risk does this then create, where you have a situation where a significant portion of income comes from interest income, a significant portion of that comes from these loans, and the cost to income ratio is as it is constructed. It does begin to paint a concerning picture for the banks to say that a material variation on something like impairment provisions will fundamentally impact the profitability of this sector. If you look at what we call the most optimal zone, there's about 5 banks which have a cost to income ratio 60%, 61% and below. It's a small number of banks. and tells you that this is really a real concern across the sector, across the industry. Now, in terms of what Bank of Uganda has done, what has Bank of Uganda done? They've done a couple of things to ease the pain in the sector. And this just gives a summarized view. I won't speak to to most of these, but the ones that are encircled are the key ones that I wanted to elevate here. That just simply says, Bank of Uganda, in terms of a priority, is saying they want to minimize likelihood of sound businesses going into insolvency because of lack of credit. Coming off that, the other one that is circled is that they will be looking to waive limitations on restructuring of credit facilities and additional accommodations for credit facilities. You have to connect that to what we've been talking about to this point that talks about the implication of the COVID-19 on loans and how critical these are for the banks, but also how important it is to enable our clients to navigate this challenging time. So what has Bank of Uganda done? A summary of what they've done from what they're defining as a customer relief program is to say loan repayment holidays for up to 12 months for impacted clients and offering this to both principal and interest. They've also opened this up to all clients, so performing and non-performing clients are open to this. And some of the key considerations that we see coming out quite strongly is that in the moratorium, it's been allowed to extend up to 12 months with effect from 1st of April and allow for up to 2 restructures within that period without impacting the credit risk rating of that loan. There are certain conditions that were required for restructures which have been waived. So Bank of Uganda, as part of accommodating clients in this difficult time, has allowed for payment of arrears not to be a requirement for restructures. So you can actually have a loan that has some arrears that gets restructured. The restructuring will not impact credit risk quality of the client. The credit classification is to remain unchanged during the moratorium period. So for 12 months, from a BAU perspective, that name would stay in that same bucket. And adverse CRB reporting would not be a factor. They have also extended the period of write-off of loans that are classified as loss, effective 1st of April for about, I believe it's 180 days. So very accommodative stance by Bank of Uganda, coming off what we've seen leading to this point. So, and this is where I come to this slide on broad implications. I won't speak to this slide simply because I believe that CPF Reader will do a much better job in terms of breaking this down and providing context, but I wanted to highlight 2 key areas, definitely for the banks. One is, we've seen what Bank of Uganda has done, but the real question now is, what do we do from an IFRS 9 application? So Bank of Uganda is freezing prudential credit risk classifications. What does IFRS then mean in terms of, do we simply carry that freeze and when the auditors come say the classification movements are frozen, or are there other subjective considerations that IFRS 9 will take that will define that? Large-scale payment holiday applications have been given out. A lot of, in fact, I was listening to in Kenya, about 30% of the loans have been restructured. Does that automatically trigger a significant increase in credit risk? No, that's the answer. But we need to unpack that and say, how else might we think about that implication and what are the considerations? The other one I'll speak about on this slide as my last point is on the forward-looking expected credit losses. We've seen the macro, we've seen the environment. It's a challenging macro environment. What does that mean in terms of how we embed that into our forward-looking aspects of IFRS 9? And we need to spend time determining what are appropriate and balanced macro indicators. So we can't just choose, 4-3. What is an appropriate balanced basket of macro indicators to use as we apply this? But also, how do we better include scenarios? And in these scenarios include some key information around fiscal response actions. The FID, which is the final investment decision, is also a factor that could impact that. And then the timing and severity of the pandemic phasing is a very key factor for building scenarios into those forward-looking assumptions. And then, of course, the assumptions on monetary policy actions. And those are some of the key issues that are being elevated coming off what we've seen to this point. I do have a few other slides here, but in terms of the implications of the standard, I would then request that CPA Frida will be taking on that part in a bit more detail, and not to overlap ourselves and allow for sufficient time for Q&A. I will, on that basis, not speak to the detail of these slides, even though we will circulate them. And at that point, pause and thank you for listening to me up to this point. Thank you very much.
Okay, thank you very much, CPA Frederick Mogeza, on the highlight on that IFRS 9. I believe there will be a number of questions for you in course. So you can also look at the Q&A tab and see if there are any questions which you can answer online. So in the meantime, we want to quickly invite CPA Frida to make a presentation so that we can have a lot of time for discussion. CPA Frida, are you there? Okay, she's sharing her screen.
Thank you, CPA Dr. Albert Otete. And good afternoon, CPAs. I hope you're all well and keeping safe.
Yeah, I think so.
Thank you, CPA Samuel, for appropriately setting the context of this session and for the insights you've given us. So for the next session, I'll basically be going through the audit and accounting considerations of the impact of COVID-19 on IFRS 9. And before I present the agenda, we'll basically take you through the accounting considerations and the disclosure requirements. And one thing I can promise you at this point is that you will probably not have all the answers to the questions you may have by the end of this session. And this is because, as we all know, we're dealing and operating in an uncertain environment that is rapidly changing. And no one really knows what will happen in terms of how long it will take for things to settle or what the impact will be. 2020 is supposed to be the third year of implementation of IFRS 9. And I must say I was looking forward to having easier conversations with my clients. And now in comes 2020. With COVID-19 and a whole new twist, as Samuel has pointed out. The pandemic has had a detrimental impact on economies the world over. We've seen changes on economies, changes in the macroeconomic factors, economic forecasts, and these are actually changing week on week, still with a lot of uncertainty on how long the growth rate will be negative or how quickly it will rebound. Samuel has given us a high-level overview of what's expected to happen in the sectors. We've seen disruptions to operations in many sectors, cash flow constraints, changes in unemployment rates, and the various economic factors. And as we go through this session, we'll be able to relate the impact of this on IFRS 9. So just a recap on IFRS 9. It requires that expected credit losses are measured without bias, using reasonable and supportable information that's available without undue cost or effort at the reporting date. So basically what I'm presenting before you is just how they are computed. Companies are required to apply judgment to be able to evaluate, firstly, what is the probability that a debtor will default? This could be due to financial difficulties, or the debtor simply had no intention of repaying the debt, or even that the debtor has decided to take advantage of the COVID-19 situation and not settle what they owe. Secondly, after determining that there is a likelihood that the debtor may default or not honor their obligation in full, how much is the lender owed? This is what is called the exposure at default. And people have been seen to be drawing down more of their unused facilities, and therefore the amount of risk has been seen to go up. Then in the case of default, how much in percentage terms will the lender actually lose, and when will this loss occur? The standard gives two approaches to the ECL computations. I'm sure you all remember these diagrams from the first years. And there's the general approach and the simplified approach. I believe the majority of attendees are corporates and use the simplified approach. So with this approach, it generally deals with short-term receivables. And the basic concept is that the company determines historic loss rates of the receivables and then adjusts them by forward-looking information to be able to compute the expected credit losses. The general approach is a bit more sophisticated, and it's typically used by banks where receivables have a significant financing component. And the principle around it is, it uses a concept of staging, where facilities are classified into different stages in accordance with their credit risk characteristics. The lowest risk assets or performing assets are held in stage 1, and they are continually tracked to assess whether there's a significant increase in credit risk to be considered. In stage 1, the credit losses are usually lower as they are based on default events that could possibly occur within the next 12 months. And if it's found that there is a significant increase in credit risk, the facility would be moved from stage 1 to stage 2. And credit losses then computed based on the life of the facility. And if the loan subsequently goes into default, it's then moved to stage 3. So there's quite a bit of estimation and use of judgment to determine the stage of the facilities. And there's also a lot of forward-looking information that's used to compute the amount because of the uncertainty. So a range of possible outcomes is considered and weighted before determining which would be the most reasonable estimate. And the need for this forward-looking information is where comes the challenge, and especially in such an uncertain time. The International Accounting Standards Board published an educational document a couple of months ago, in which it acknowledged that estimating ECLs would be challenging in the current circumstances. The key messages in this document were that, firstly, a number of assumptions used in the previous ECL computations may no longer hold in the current environment. Then it gave guidance on how to treat the payment holidays given to borrowers. As CPA Samuel has taken us through the relief measures of Bank of Uganda, and I'm aware that also Uganda Microfinance Regulatory Authority gave an allowance for a moratorium to be given to borrowers. I suppose the same would also apply to corporates who opt to renegotiate their payment arrangements with all their debtors. The ISB also said that if the effects of COVID-19 cannot be reflected in models, companies should consider what overlays could be applied. The document emphasized that despite the expected challenges and high levels of uncertainty, the changes in economic conditions should be reflected in macroeconomic scenarios and in their weightings. I must say that at some point there was a misconception that IFRS 9 impacted mainly banks. But since ECLs require the use of forward-looking information, regardless of the approach that is used, I would say it's as much an issue for corporates as it is for banks. And in the next sections, I'll just take you through what would be the key issues for practitioners to consider and what companies should be thinking about. Okay, so the impact of COVID could be considered at counterparty or data level, where we'll be looking at specific data circumstances. And the biggest question around this has been on how to deal with the moratoriums and payment holidays. A week or so ago, I received a rush call from a client who mentioned that she was in a meeting and wanted a quick yes or no answer. She was like, Frida, for the clients who were restructuring, must we move them from stage 1 to stage 2 for IFRS 9? And at that point, I did not know she had budgeted 1 second for my answer. So my quick answer was no. And before I could get to the but, in order to complete my answer, she had hung up. But had I known, I would have used my 1 second to say it depends. And then maybe I would have had myself a bit more time to explain to her. So what would we say it depends on? The guidance from IASB, as CPA Samuel mentioned, is that it does not automatically trigger significant increase in credit risk. And here the keyword is automatically. And this particularly applies for blanket payment holidays. I might just like to give you a quick illustration of this before I proceed. We've got Mr. X, who's in the scooter business. He has financed his fleet of delivery scooters using a 5-year bank loan and is required to make monthly installments. He's always been a customer in good credit standing, and prior to the lockdown, he had never missed an installment. He has had no income since the lockdown and has opted for a 3-month payment holiday from his bank to avoid defaulting on his loan. So if the bank modifies his loan agreement to give Mr. X a 3-month payment holiday, would this trigger a significant increase in credit risk? So like I said, no, actually I wish I was able to take a poll and see what the answers would be for this. But like I said, it is, the significant increase in credit risk is not automatically triggered. But from the facts of this case, it would appear that Mr. X is only going through a temporary liquidity challenge and will be able to recover not long after the lockdown, in which case his account would have no significant increase in credit risk. However, companies need to assess the specific circumstances around the data, such as whether the data was already showing signs of financial difficulties before the outbreak, and if so, was it tending to significant increase in credit risk even then? Then secondly, whether the data is undergoing a temporary liquidity shortfall, or if there's to be a more permanent impact. This could probably be considered depending, say, on the sector of the customer. For example, if a customer is in the tourism sector, if they were given a 3-month payment holiday, would they be able to recover as fast as, say, a supermarket? It could also depend on the overall indebtedness of the borrower and whether they'll indeed be able to generate the future cash flows for the restructured arrangements. Now, all this said, one would ask how practical it would be to do this assessment on individual data level. It could be possible for the smaller data books. However, for many, they may need to categorize the data into classes of similar characteristics, which would bring us to the portfolio considerations. Pooling of loans could consider factors such as the geography of customers. For example, customers from South Sudan could have similar characteristics, and which could be different from, say, customers from Kenya or China. Then they could also consider packaging them in sectors. As discussed earlier, COVID has impacted sectors differently. So if so, the customers in the different sectors may probably have similar performance tendencies. There is generally no automatic approach. Companies are expected to document the basis for the classification, and where possible, overlay approaches may be needed. For the macroeconomic scenarios, there is really no consensus on focus of the future, and this is likely to remain the case for some time. And this means benchmarking will be harder, and it's likely that there'll be more reliance on overlays and expert judgment. And what this means is that companies would need to have more detailed disclosures, because this may be the best point of reference for purposes of comparability between performance of companies. Then scenarios will need to reflect consideration of possible outcomes, the severity and length of the pandemic, and possible risk of future outbreaks, and what this would mean for the path to a steady state. Then weightings of the macroeconomic scenarios are expected to change, where there will be increased need for justifications and expert judgment. There may be a need to apply a lower weight to the base case, and this is because of the prevailing uncertainty, and also to give more prominence to the downside weightings. Again, overlays may need to be applied to capture the uncertainty. However, the basis must be documented, and transparency in the disclosures and assumptions will be very critical. So just to sum up, for companies that are using the simplified approach, you will need to consider if the impact on any renegotiated arrangements, how it can be factored into the models, the simplified models that we're using, whether it has an impact on the days past due, then what would be the appropriate rates to adjust the historical loss rates. We'll need to consider whether the facilities are still short-term, considering the revised arrangements, and whether there's now no significant financing component to be considered, in which case we may need to shift from the simplified approach to the general approach. Then also consider whether it's possible to classify the different data into their different risk concentrations. For the general approach, we'll basically expect that there'll be updating of scenarios. We'll need to reconsider multiple scenarios and allocate appropriate weightings, check what the impact of the lockdown and restrictions have been, and consider how this can be impacted, or how this impacts on your assumptions, the impact on the economy, and the respective macroeconomic factors that are used in the models, changes to the interest rates, and then also to incorporate any other relief provided. Then other considerations for the collateral-backed assets, we'll need to determine or to consider whether they are still appropriate. And this is in regards to, say, if there'll be a need to foreclose on a loan, would we still be able to have the collateral that we hold disposed of? And if so, how long would it take us to do so? And then considering the value that we have documented for it, is it still appropriate? Would we still take the for sale value as the expected future cash flows, or do we need to apply any haircuts to the values we have? Then also to consider what reputation it could have on the entity, considering the timing of the actions. And also consider whether there are any legal considerations. For the impact on other credit enhancements, I think for this I'll take an example of the financial guarantees. One would need to consider if the financial guarantee is integral to the contract, and if so, whether it reduces the expected credit losses. However, considering the circumstances, one would need to have additional demonstration that the financial guarantee contract is legally enforceable and that the guarantor is actually in a financial condition to be able to order the pledge if required. It's not sufficient to simply take the financial guarantee at face value, but an assessment would need to be done and documentation needs to be held for the respective guarantees. So just an overview of what companies should be doing. We would expect that they are getting documentation together to ensure that they have reasonable and supportable documentation for any macroeconomic assumptions used. They'll need to consider the need to adjust models through overlays and also have this appropriately documented. We should be performing a sensitivity analysis to support any key assumptions and judgments and consider the range of possible outcomes. Then ensure there is appropriate governance around the key areas of judgment to ensure any possible elements of bias are eliminated. Consider if you have the appropriate resourcing or resources, or if you'll need to engage a consultant at this point to assist with this process. Then also to incorporate the impact of payment holidays and other relief provided to customers into our models. So as I said, we'll need to, in the long term, we'll need to make sure we are refining our models to ensure we have a revised baseline scenario, check if there's a possibility of including the impact of the pandemic and any future such occurrences, including the likelihood that they could reoccur. Then basically checking the overall risk management policies of the entities and ensuring they're appropriate to give early warning indicators. Then for forbearance and debt modifications, companies need to consider what the impact of the measures such as term extensions, interest or debt forgiveness could result in the amendment of contractual terms of the financial assets. I could take an example of a landlord-tenant arrangement whereby a tenant asks the landlord that he's allowed to pay the rent after 6 months. So you'll find that in addition to the landlord bearing the credit risk for the 6 months, with the tenant staying in his premises without making any payment, there's also the time value of money to be considered for the time that the landlord is not getting any cash flows for the space he's letting out. So a consideration would need to be done of whether there's a substantial modification of the contract. And if it's found that it's not substantial, the landlord would need to, at that point, account for the modification, loss or gain on the date the modification of the arrangement takes effect. Then a second example, still using a landlord-tenant arrangement, would be if the tenant instead asks for a moratorium of 2 years. So the landlord is to forego rent for 2 years, after which the tenant would start to pay the arrears. This arrangement would change from a normal short-term receivable to a long-term receivable, and there would be an element of a significant financing component which would even be introduced. In this case, I would say there would clearly be a substantial modification of the contract, which would require that the initial asset is derecognized and the new financial asset be recognized on the balance sheet at the revised terms. And at this point, the landlord would need to consider if the asset is credit impaired at initial recognition. And considering the circumstances under which it arose, it probably would, in which case the landlord would need to account for the lifetime ECLs. For considerations on bond portfolios, for this, I'll just take an example of investments in government bonds. These are usually considered to be low credit risk. And therefore only the allowances that are recognized in the balance sheet are usually based on 12-month ECLs. But now with the changes of that COVID-19 brings, it now calls into question whether the securities would still be considered to have a low risk of default, and that's presumed to not have a significant increase in credit risk. This again should be considered depending on the portfolio held by the company. For securities such as investment grade bonds, the company would need to check whether the ratings of these bonds have been affected and whether a reassessment of the assigned credit risk needs to be done. Then for classifications, for this one, we'll just give an example of in a case where the entity has classified some of its bonds into a hold to collect and sell business model, where they are classified under fair value through other comprehensive income. And then subsequently during the year, it changes its strategy to now hold the bonds with no expectation of sales. In that case, a reclassification is not expected to be permitted. However, for the newly acquired bonds, they may now be classified at amortized cost if they are deemed to be part of a separate portfolio managed on a hold to collect basis. Then under fair value measurement, I'll talk particularly about investments in securities, both quoted and unquoted. IFRS 13 on fair value measurement requires that fair value is measured at a specific date based on assumptions that market participants would make under current market conditions. Over the past weeks or months, I'm sure we've seen a decline in the prices of equities traded on stock markets. And on the basis that the prices are still on the stock markets, the volatility should not change the way the fair value of the instruments is measured on the reporting date. So I'm expected to value the instruments based on the market price prevailing on the measurement date. The unquoted equities are, however, more complicated as the information used to value them is largely not observable. And a common method used is based on discounted cash flows, and these are based on forecasts in the company's business plans. The issue would be with the assumptions used to derive these forecasts, as they may no longer be appropriate under the circumstances and may therefore need to be revised. And important to note are the fair value disclosures, where companies should ensure they disclose sufficient information for the users to understand what the impact of the COVID-19 outbreak has been on the fair value measurement. Then finally, for disclosures, companies will need to have detailed disclosures on the nature of assumptions used or other estimation uncertainty, and also document or perform a sensitivity analysis of the impact of the changes to these key inputs or assumptions on the carrying amounts. There should be an explanation of changes made to past assumptions. And then also for the disclosures of the key assumptions used and judgments made in estimating ECLs, the values of the key macroeconomic inputs used in the multiple economic scenario analysis should be disclosed, including the probability weights of those scenarios, the assumptions used to determine the impact for the specific sectors. Any management overlays used should be disclosed in detail. The disclosure should also allow the users to be able to understand the nature and impact arising from any material reliefs offered to borrowers. And then lastly, for IFRS 7 disclosures, there should be sufficient detailed disclosures on the company process for financial risk management. And there I just give the details of the respective risks to be considered, including how they are managed, how they're impacted by COVID-19 and the respective sensitivities surrounding them. So in conclusion, what entities need to be doing to ensure compliance? And firstly, they should not underestimate the work that needs to be done on this impact. They should try and follow the government and regulatory developments and pronouncements, but also note that regulatory pronouncements do not override IFRS, so they both need to be considered for purposes of financial reporting. Then engage with regulators, with your consultants or auditors early in the process for clarifications on any guidance. Then we'll need to ensure there are robust controls and governance processes within the company. And I think I'll stop here. I'll just say thank you for listening. Over to you, Dr. Albert.
Thank you, CPA Frida Agaba, for that presentation. And we have so many questions which you can look at from the question and answer dashboard. And the members are really wanting to get answers. So dear members, as you have seen the presentations, IFRS 9, indeed this is the third year, 2020, the third year of when it is mandatory. You have heard about expected credit losses, which is the key model in the standard, where you are required to have probability of default, then the loss given default, and exposure at default. You have also heard about the need to gather forward-looking information. So for those of you who are working, make sure it is gathered. For those who are auditing, ensure that you can verify that information. Dear members, there's a poll that will be running at this stage. So please answer the question such that the institute can gather the views of the members. So you have also heard about the staging, which is very critical for IFRS 9. Stage 1, which are performing financial assets, you only need to take 12 months expected credit losses. But stage 2, where there's a significant increase in credit risk, you have to take losses for the lifetime. So the presentations will be shared with you, and then you can also conduct further research and reading in the books. You have a lot of IFRS books. We have an example here. So you can acquire a copy for yourself and make sure that you can read further about IFRS 9. And we have seen that there is simplified and general approach. So make sure you choose the right one which fits the purpose for your organization. So without wasting any further time, because we need to complete by 3:45 or 3:50. So I want to get answers from some of the panelists. I've noted down here some questions. CPA Frederick Mogeza and CPA Frida will be able to answer some of them. There are quite many. So I'll just pick 5 first of all. So CPA Frederick and Frida, are you ready?
Yes,
Hello?
yes, I confirm that ready to give it our best efforts.
For example, you're going to note them down and then we shall see which ones you can answer. The CPA Yasin is asking about why fuel prices have not fallen drastically in Uganda, despite, of course, seeing that crude prices have fallen to less than $30 per barrel, and even the futures at some point were negative. So that is one question. The second one from Apollo. Risk assessments for IFRS 9 disclosures. What advice on risk assessment for SMEs in Uganda? Then we have Alexander is asking. He's asking, of course, something which is not in the forum, but you can still think about it. Talking about NSF 20%, the impact on the economy. Then Moses, Matthias Ngobi, Edison in Sarimana, Tom Atwaire are asking about whether banks need to revise or remodel their IFRS 9 from scratch. Chaplain is asking about impact of COVID on fixed deposit accumulation, given that businesses have been low during the lockdown. Then maybe the last one for now, what is the impact of Bank of Uganda recommendations? I think you talked about those credit relief guidelines. What's the impact of those recommendations on IFRS 9 model? I think we can first answer those before we go to the next batch of 5. So we can start from with the CPA Fred. Rick.
Okay, thank you. Thank you, CPA Albert. And I must thank CPA Frida for not only giving the remark at the beginning that said that, you know, the panelists may not have all the answers, but we have whatever insights we can share. And, you know, and then from there we open it up and have robust engagement, interaction, discussion, insight. I think there is no excuse for absence of data. It's always good to build, you know, data-driven insights. So as much as is possible, we will provide some context on some of these issues. Now, fuel prices, interesting question. I rightly say that the prices globally have come down. In some futures we are trading at a negative. Many traders were dumping their futures, but the pump prices haven't materially moved. And I'm not an expert on you know, the fuel pricing considerations, but typically there are factors around what they have stocked and how quickly they move through the stock. There are embedded logistical challenges down the value chain that impact how quickly price changes impact the pump price. So even though we have seen a marginal drop, I think the petrol price has come down at about maybe 50 shillings or so, but nothing to the extent of what one might expect. And then there are also some base fixed costs within what might inform a price point. So on a general level, what I would say is that intuitively, one will expect to see a drop on the pump price over the next period. How quickly that registers into the fuel price, is also dependent on other factors on stock and logistical aspects, that are costs that are built up into the pricings of these entities. But generally speaking, one might, expect to see that pump price, come off, given where the price points are. In terms of risk assessment for SMEs, risk appetite reviews are going to be very critical. And for all of us to step back and say, what drives value in our business? What are the things we depend on? So you look at your value chain and look at the ecosystems that you're exposed to. So if I think about maybe an SME, you think about your logistical process, how you get things into the organization, where your dependencies. If you had a dependency on China or importing product from different markets, then there is a risk there. How quickly can you replace that dependency with a more predictable dependency becomes a key question. And how quickly are you able to do that without disrupting your supply chain too much? You think about things around the fact that markets are contracting. Are you able to and when you say markets, you have to think about the logistical aspects of delivering your product to the marketplace. So if it was dependent on export, then there's a significant disruption there, and you have to integrate that and say, are you able to get a different market? How quickly are you able to do that? If it's that your product was heavily dependent on mobility, then the question is, are you able to create a digital solution or a solution where people can interface with your product without having to walk past the shop? So you have to think about your value chain from an end to end, and begin to interrogate and ask questions about each point of the value chain. What is the disruption? How can you pivot and begin to, protect your business in light of what has happened? How quickly can you move? And who are the partners you need to work with differently? But it's a big piece of work, and it's one that will not naturally go away by hoping it goes. There has to be deliberate time spent to do that. Banks are doing it. Small entities are doing it. I was speaking to a company the other day that has a great business model that has been severely disrupted. And what is hard to do is to step back and say, how else can he create, using his current value chain, his current production line, how quickly can he use his product for a different market? And he's found some interesting ways to do that. And that's the work that all of us have to do, to say, where else can we trap new value in light of the disruption, and how do we reinforce our supply chains as much as we can? NSSF, 20% on the economy. Look, it's an interesting debate. There's people on two sides of the fence. My 2 cents is that the intent of this bill is to increase liquidity in the market, which basically means there's more purchasing power. People are able to buy. There are more people able to buy things in the market. That's a stimulus in the market. Economics tells us that is, a stimulant in the marketplace. But then also one understands that NSSF is the single largest buyer of government debt and equity. The point was made that the equity positions have taken a hit. If there was a requirement to liquidate significant amounts of that, how might that impact? If we look at the assets distribution of NSSF, most of it is government securities. So one has to make an assessment of what is the implication of a significant reduction of that. I think there's an answer in the middle. I don't think it's a hard left or right. It's where is the opportunity to create some liquidity for people so that they can get some funds out and do some things without fundamentally impacting, these long positions that have been taken, that liquidating quickly would cause a disruption. The point of the matter is all of us need to be thinking about contingency planning, and I expect NSSF has thought about some level of contingency planning if a scenario like this were to arise. And I expect there's a lot of smart people there who've worked out some numbers around what losses can be taken, because there would be losses if we needed to do something of that sort. There would be losses, but the whole economy is experiencing losses. So what is that acceptable level of pain that would be taken? And that work has to be done. My 2 cents is the answer is somewhere in the middle. I don't think it's a straight airway. I don't think it's a straight don't give. It's to say, how do we release cash in a meaningful manner, but does not add even more disruption to the disruption we're facing currently. In terms of banks revising their models from scratch, I wouldn't think you have to revise from scratch. We're not revising from scratch, but you're going to have to do some tweaks. You are going to have to do some. You're going to have to relook at, your forward-looking basket of parameters and see how to enrich that. You're going to have to do a lot more scenario work on that. You're going to have to document a lot of that because there's going to be a keen interest to see the quality of documentation that is informed the actions taken. And the models will have overlays, which simply means, I think CPA Frida spoke about that. I won't really repeat what she said. So the basic models in of themselves, if they were robust to begin with, would not need to be written from scratch, but there will have to be refinement on the inputs, a lot of work on the inputs, and also how we think about overlaying those models for factors that might not naturally come through from the data spewed out. Like sectors, and if there are certain sectors that are nuanced, that you have to then do an overlay specific to that sector, that work has to be done. And that's the big piece of work I suspect will have to happen from a governance and documentation perspective. In terms of COVID and fixed deposit accumulation, there's less liquidity in the market. There's less velocity of money in the market. The money hasn't magically disappeared. It's just that it's not moving as quickly as it would have if we had mobility and things were happening as they should have. So what we are seeing is an interesting pattern where some people are building up their cash. Investment decisions are being held. Transactions, people are more cautious about where they transact, how they transact, what they're buying. So there's a lot more caution about people holding back some funds. We are seeing people, typically who would be putting money in real estate are pausing to say, let me wait and see direction of real estate. So let me keep my money in some monetary or hard currency, which is dollar or other foreign currency investments. So there will be a buildup of liquidity in the places that need mobility, in those places that naturally have those pools of liquidity, those funds, and people who typically were heavy focused on transactions will see a constraint on their liquidity. Traders, people who are dependent on that activity will have some constraint, but people who are typically the large payers out of liquidity, the NGOs that have received their funding pools and allocations, you will expect that there will be a build-up of some of those cash flows. Impact of credit relief from a Bank of Uganda perspective, and that's been an interesting debate because Bank of Uganda has provided a lot of good accommodation, and it was necessary to do that because the impact of the regulatory prudential guidelines directly impacts capital and equity. And if banks are not allowed the flexibility around how they manage the impact of capital and at the same time manage the relief to clients, you'll invariably find a situation where there's a disconnect between sustainability for clients and for banks. Now, you cannot just transplant what Bank of Uganda has said and put in IFRS 9. One has to review the circumstances around these restructures, the circumstances around these clients that may have been distressed severely before, and then take a really informed view about what the appropriate action is in light of that information. So the quality of your data, the quality of that information will inform the right outcome. This is not an opportunity to hide losses because of the dispensation we received. And we must continue to do the right thing to take, if there are distressed names that were distressed before, we have to take the right actions. But if there are names that we are simply accommodating and providing some relief, then we have an opportunity to provide that relief without creating higher losses. Thank you.
Okay, thank you, CPA Frederick, for those answers. So if you have an opportunity, you can go and respond, even some online, such that members can get answers. It may not be possible to really answer all of them face to face. So now I want to invite CPA Frida to answer some questions which are specific probably to accounting and also auditing. Since you E&Y provides some of these assurance services. So the first one, Frida, are you listening? Frida?
Yes, I'm listening.
Okay, the first one is from about two members. They are Ude Balara and Abu Agawo. They are talking about the impact of COVID-19 on the financial statements for the year ended 1st December 2019, especially given that the WHO declared the pandemic in March 2020. So I think this is relating to the International Standard on Auditing number 560 regarding subsequent events. So how has this COVID, how should it be treated in the financial statements? That's one question. The other one is about how, is from Gunit Santok, how can force majeure be factored into overall credit ratings? So in case we have such clients, how have you seen it being treated? The other question is about going concern. This is ISA 570. So COVID-19 has affected some companies and they're on the brink of collapse. So there may not be a going concern in the foreseeable future. So how should auditors, this is talking about practitioners specifically, how should they go about assessing the health of the company as to whether it's a going concern? The other one is from Silva Chayune. What's the most reliable source of macroeconomic variables to be used for IFRS 9? The other one is from Winnie Nakazibwe and Julia Sowor. This is talking about IFRS 9 for SACCOs and microfinance institutions. What guidance can you give to them? Then maybe the last one for this batch, a number of landlords are unable to collect rent from their tenants. There's some kind of holiday. So how should these landlords, if they are companies, how should they factor that into their IFRS 9, and especially given that COVID might continue for a while? So I think CPA Frida, you can answer those, while some, Frederick, can be answered some online. Thank you.
Thank you, CPA, Dr. Albert. So the first one is on the impact on the financial statements for the year ended 31st December 2019. They talked about whether COVID-19 is a post-balance sheet, an adjusting post-balance sheet event. For this, by the time the company is preparing their financial statements, I believe they should have information relating to the balances as of the reporting date. And what we are currently advising our clients, firstly, is they would need to perform a detailed analysis of what would be the impact on the different financial statement lines, just to be able to give more information to the users in terms of disclosures on what would be expected going forward. The financial statements of 31st December 2019 could or would include some estimates and judgments basing on information that was available as of the year end, which information could have subsequently changed. So we would expect that the companies are using the change in the circumstances or the changes in the economic environment to be able to reassess these estimates and judgments and just basically give as detailed a disclosure as they can in their financial statements for the users to understand what could be the impact on the estimates or the judgments that have been disclosed in the financial statements. Then in regards to the force majeure clauses, how they can be factored into the overall credit ratings, and these are mainly impacting on the contracts that have, say, collateral arrangements, where in those circumstances would need to determine whether we can indeed rely on those contracts or the collateral to be able to either use it to reduce the expected credit losses. In terms of the overall credit rating, if collateral is the main fallback position, say if we can see that the facility is going into distress or it's already in default, and that's the main fallback is a collateral, then of course it would bring into question how reliable those credit enhancements are, if we can even rely on those credit enhancements to reduce on the credit risk of those particular contracts. And in terms of going concern, would expect, like I said, would expect at this point that the companies are doing a going concern assessment, regardless of the sector that the company is in. Going concern is not based on the financial statements date. That's for the financial statement for the year ended 31st December 2019. Wouldn't be considering that date of the financial statements. Would be considering the date that the financial statements are being signed off, or the date of the audit report, and for the 12 months going forward. So companies should basically be assessing, depending on when they're closing their financial statements. Would expect that they do a detailed business or cash flow assessment to be able to check if the business is sustainable going forward in terms of, firstly, depending on the sector that the business is in, whether there's sustainable business to take it for the next 12 months, in terms of the liquidity position of the company, whether it's in a position to be able to meet its obligations for the next 12 months, whether they're able to generate sufficient cash flows, and also looking at the different measures. Different companies have taken different measures to be able to manage the cash flow constraints in their businesses. Also to see how those would impact on the businesses and what impact it would have on the going concern of the business. Then as auditors, we would need to, of course, get this information from management and critically assess the key assumptions that are used to support the information, because a lot of it will be forward-looking information. We'll need to understand what is the basis of the assumptions that they've used to prepare their cash flow projections and assess whether it's reliable. A number of companies, this is the subsidiaries, get financial guarantees or letters of support from their parent companies. In the current scenario, we would need to assess whether the parent companies are also in a financial condition to actually provide the support that they say they can provide. Even the letters of guarantee would need to be asking if those letters of guarantee are legally enforceable, because a number of subsidiaries get letters where the parent company pledges that they'll be able to support the subsidiary financially and ensure they keep them, it's kept as a going concern. But in this case, we'll find that the parent companies may also be struggling. So would not be able to rely on only the assessment done by the local entities, would need to get any additional support to assess the impact of any parent company that's offering or pledging to give financial support or guarantee to the companies. Then in terms of the sources of information for the macroeconomic variables, there are various sources of information that we see that are used. There are rating agencies that provide this information. So I don't think I could point out and say which is the single most reliable source, but what matters most is that we ensure we are able to justify the source that has been used, the source of information. Like I said, there are different rating agencies that give similar information that can be comparable. But what would be very important is to ensure that the information or that the sources of information are consistent. I wouldn't expect that a company is using a rating agency one in year one, then changing year on year, changing the sources of information year on year. The most important issue is that we should be able to use a reliable source, justify what the source is, and then apply the information, use it consistently. Then for IFRS 9 for SACCOs and microfinance institutions, I would say there's no, I don't think I quite understood the question, but there's no real difference in the way the accounting, say for expected credit losses are for IFRS 9 for SACCOs and microfinance institutions. We still expect that they're using the general approach, and all the considerations in terms of determining whether there's a significant increase in credit risk could be applied. I've seen some where they have more short-term facilities where the loan products have shorter-term facilities where they have actually justified the use of the simplified approach, because regardless, the loan still falls within, say, under 12 months, and they'll still need to use the lifetime ECLs to compute or to recognize their impairment. So it's something that SACCOs would need to assess the portfolio, or microfinance institutions need to assess the portfolios that they have. In some cases, it may be appropriate or possible to categorize them into different brackets. Some could be, you don't have to use one single model. You could actually have a mix where some of them could qualify to be done under using the simplified approach and some using the general approach. So it really depends on the mix of customers that you have, but you basically need to ensure you have a documented accounting policy that justifies the basis of the approach that have been used and why, and which one would give a more reliable estimate. Then in terms of the landlords that are unable to collect rent, I think I'd given this example where I would expect that the landlord assesses what exactly is the modification that's being given to those contract arrangements, and then to assess, is it a substantial modification to the original terms or the original rental arrangements that they have with the tenant. I'd given an example of one where the tenant had opted to, or had requested that they do not pay for 6 months. And for that case, I had just estimated or said that it may not be substantial, but it's something which the landlord would need to assess and see what exactly is the arrangement that I have with this tenant. What modification are they requesting for, or what moratorium are they requesting for, and then to assess what would be the change in the terms of the contract, because there's the issue of the time value of money which needs to be considered or incorporated as the landlord is doing the accounting. So they'll need to, at the point that the rental agreement or the arrangement has been renegotiated, they'll need to assess and see if there's a loss that needs to be recognized in the financial statements of their books at the date that the agreement is modified. And for that, I suppose we can have a more detailed discussion on that offline, depending on what the arrangement may be. Over to you, CPA. Albert.
Okay, thank you, CPA Frida, for answering those questions. So I think definitely we have run out of time, and I believe that the Institute will circulate the presentations to the members. Definitely, the way they contacted you is the way they will be able to circulate the link.
Alfred, you still have 20 minutes.
Oh, 20. Okay. So in terms of
Albert, you have 20 minutes.
Okay. So you still have a chance to really get more of this information and contact the panelists and continue the discussion. But we have been told that we have another 15 to 20 minutes. So we are going to maybe address more questions to the panelists. So we have more here. Then we shall see which one is relevant for CPA Frederick and which one is for Frida. So the first one is from Hahab. It's talking about the conversion of loans from foreign currency to local currency, as to whether this can help in restructuring of the loan and maybe avoid the challenges of IFRS 9. Then from Claire, she's asking that the bank staff sometimes do not understand the mechanisms of IFRS 9, and yet investors need this information to determine whether they need to invest in treasury bills, treasury bonds, or whatever investment, fixed deposits. So CPA Fred, this is specifically to you. And then there's also a question about, there's a heavy tendency for people to invest, or people and institutions to invest in treasury bonds. What are the implications of this on the economy, especially in terms of cash flows? So I think you can answer those while I pick out more, which may not have been answered before.
Okay. Thank you, CPA Albert, sorry. So in terms of conversion of loans from FCY to LCY, one has to understand, what are you solving for by, because the restructure is meant to solve something. You could, it's possible to restructure facilities either from long-term to from short-term tenors to long-term tenors, and also from foreign currency to local currency. And all these are, available ways that one can restructure. It has to be clear what we're solving for. So if this is a client who initially was expecting foreign currency inflows, but based off the situation in his business, he sees that he's unable to continue to do so because his foreign currency inflows are disrupted. So either he was operating as a landlord with foreign currency rentals, but his clients are now shifting to require local currency, or he was an exporter, but now he's redirected his market internally. One has to understand the intent there. And also so that's first piece. And if it is such that the nature of the cash flows has evolved, and the client would now look to get a pattern of cash flows that are more consistent with his inflows, it does make sense for you to translate those cash flows into the currency where his inflows and receivables are going to be coming from, because that reduces pressure. So if a current customer is receiving local currency now and you maintain a foreign currency schedule, you put foreign currency risk on him that he cannot manage because he's not receiving foreign currency inflows. What one also has to ask there is, are there other signals within that request that represent that the account is under material distress? And because remember also, when you move this transaction from foreign to local, the interest rate will have to change in line with how local currency transactions are priced. And one has to do a cash flow assessment to confirm, from a cash flow, are these cash flows impaired, etc. So the intent guides the approach, and in terms of being able to do it, you can do it, but you need to ask yourself the questions that then give you a sense of whether this is a facility that is showing significant increase in credit risk, and in which case you have to take a decision around what stage you should sit to and how you move that, versus easing the cash flow pressure because of a change in business model or business strategy where the cash flows are coming from. In terms of the bank staff not understanding IFRS 9, I think feedback is a gift, and when we receive such feedback, it's important to take it. I think what we have tried to do, and I can speak also from, because I used to sit on the UBA for the CFO forum, I think a lot of work was done to enlighten the CFOs and heads of credit around IFRS 9 implications. And what should happen is organizations should find a way to disseminate this information to the frontline staff who are engaging with clients, so that in a language the client understands, there is a sensible conversation that guides the client on the right decision. For Stanbic, we've tried to do this, not as well as we would like, but what we've tried to do is show clients what are the implications of a short-term loan, of a long-term loan, of a currency that disconnects with their inflows, and all these things that should hopefully guide a client to minimize risk that they don't need to be taking. And the solution for that is to continue sensitization of staff, and to do so in a language that clients can understand, not in the technical IFRS 9 jargon that accountants like, but what is the implication for a client, and how does that inform a decision the client will take. Then heavy tendency, I hope I answered that question. Heavy tendency to invest in T-bills and bonds. And I suppose what the question is talking about is a crowding out effect of all these funds, all this liquidity, instead of going to the private sector, going to the public sector and funding a government through these bills and bonds. Now, I think typically what we all say is that it is good for this liquidity to drive private sector and to be playing a meaningful role. And where there's a material increase in what is going to government securities, either in terms of increased auction sizes, that would send a signal that there's going to be less available liquidity in the private sector. If I look at the behavior that we've seen from Bank of Uganda, even though there is an increase in requirement for government borrowing, we are not seeing the auction sizes increase, which means that government is sourcing this additional funding from other sources, either through bilateral loans or through other sources of funding, but they are not specifically putting pressure in terms of incremental auction amounts, which is a good signal. The fact that interest rates, or rather the tax rate on the long tenor instruments has been reduced, is also a signal to help reduce the cost of debt for government, but not necessarily to increase the debt going to securities, because that signal would come from increased auction sizes. So I think there's enough liquidity. I can say that if I look at the numbers I see for loan to deposit ratios, there is sufficient liquidity to fund private sector requirements at this point. The real question is whether the risk appetite is aligned to the people making the request, the clients who are looking to borrow, whether the shape of their businesses and the going concern nature of their business is in line with the risk appetite of the banks. But we're not at a point where we can say that there has been crowding out of private sector because of government securities.
Okay, thank you, CPA Frederick, for those answers. So maybe a final one before, since time is running out, a final one for CPA Frida. This is to do with treatment of interest forfeited by a financial institution during this moratorium period. which has been recommended by Bank of Uganda or maybe even other institutions? What will be the treatment for the institution? Hello, CPA Frida, are you still there?
Yes. Thank you, CPA Albert. For the case where the financial institution has to forfeit interest, that would be a modification of the initial contract, in which case the financial institution would need to assess and compute the modification loss at that point and book that loss and modification in its income statement.
Okay. Okay, thank you for that. Now, a last one maybe. The IFRS 9, indeed, there was the view that maybe it's applicable only to banks, especially, and maybe some microfinance and the SACCOs. But now there's a question here really that for small and medium enterprises, how can they apply IFRS 9? And especially in light of the fact that COVID-19 has indeed hit every organization, whether small, medium, or large. Each of them has been affected directly or indirectly by COVID-19 in terms of repayment of their debtors, payment of loans. So SMEs, what is the final comment from CPA Frederick and also CPA Frida?
For the SMEs, I would say it depends on what framework they're using. If the SME is using full IFRS, then they would need to, IFRS 9 would definitely apply because it was a standard that came in to replace IS 39. But what they would need to be using is they would need to be using the simplified approach for accounting for the sales on their financial instruments, which is it's a less sophisticated model or approach than the general approach, and they'll basically need to assess their expected credit losses based on their historic loss rates, but then still adjust those historic loss rates for forward-looking information. They'll still need to know what macroeconomic factors have an impact on their business, and then assess and see what would be the appropriate rate to adjust their historic loss rates to be able to estimate the expected credit losses. However, the SMEs could qualify for IFRS for SMEs, in which case they would use the standard, which are specifically designed for small and medium-sized entities. The standard for the IFRS for SMEs. For those that opt to use that standard, they do not need to use IFRS 9 because the standard is still based on the principles of IS 39. In which case the current changes or the current impact may not necessarily affect them in terms of having to do remodeling or reassessing their models. They'll still need to, of course, they'll still need to assess the impact of COVID, but they wouldn't need to absolutely comply. They wouldn't need to comply with IFRS 9. So that could be an option that they could go for to assess and see if they could adopt IFRS for SMEs instead of using full IFRS.
Okay, thank you very much. If we had an opportunity to give you a round of applause, we would be hearing some claps. And now we don't have a way of clapping. So thank you very much, CPA Frederick, Samuel Mogeza, and also CPA Frida Agava from Ernst & Young for this interesting presentation about the implications of COVID-19 on IFRS 9, especially now giving examples of Uganda, which is very relevant for us as CPAs practicing here in Uganda. So I think it is time to call it a day. And I see online we have, of course, John Bosco Ntangare from the Institute of Certified Public Accountants of Uganda is a Director of Education. I hope I've got it right, JB, your title. Okay, but we also have online, we have CPA Constant Othieno and also CPA Stephen Inegate. These are council members of the Institute. And probably they will want to give final remarks regarding this webinar and also what is coming up next, since the Institute is still conducting such webinars for the benefit of all the members, since lockdown is not really fully unlocked. So CPA Constant, Stephen, do you have comments for us?
Yes.
Oh, okay. My brother.
Thank you.
Go first.
Thank you, CPA Albert, and as well Sam and Frida for excellent work done. Thank you for very insightful and enlightening presentation in terms of the implication of COVID-19 to, one, the financial institutions' lives today, at the same time, all the other companies that are impacted in one way or another. So on behalf of the council, I want to say thank you to you for speaking to us, the CPES, and most importantly, in terms of what we need to consider as we serve our clients. So thank you for the time that you've put in to ensure that we CPES are abreast with whatever is happening currently, and I trust this will support us going forward. So thank you very much. Constant, over to you.
You've said it all, brother, and maybe to just once again thank the members for showing up today. I saw it peaked at almost 550 participants online, and of course I know there were others on Facebook and other social media platforms. So this really shows us that the level of interest is quite high. Thank you, CPA Dr. Albert Otete, for the moderation, and obviously our colleagues from, of course, I see the CPA Samuel. Thank you so much, as usual, for coming in to actively participate in the Institute's activities. CPA Freda from EY, thank you so much for the good job that you've done. Of course, I need to say something that on 8th of this month, we'll be having probably what should be our last webinar, for this month, as far as the timetable I received from the Institute is concerned, and that is going to be the national budget update. Let's tune in. That will be on June 8th, and I think June 8th will be Monday. So same time, same place, and of course, wash your hands regularly, and try and keep safe. Thank you very much.
Okay, thank you very much, CPA Constant and also Stephen, for those closing remarks. So I think members wish you a nice day.
Thank you.